Welcome to another episode of Commercial Property Roadshow. You're here with Helen Tarrant, and today I'm going to talk about the properties that you should not buy in this current market. Now, each market are behaving differently right now in each and every state across Australia. Now, there's certainly some types of properties you should be avoiding, and most people think it should be office space, but actually you are wrong. Tune in as I go through why you should be avoiding some of these current ones at the moment. So if you are, and of course it depends on your risk profile, and we do a lot of this about when you bring you on as a client with us in our buyer's agency service, what kind of client, what kind of profile, what things you're looking for. But look, to start with, the most important thing is most people think office spaces is to be avoided, followed by retail, right? And then the pick of choice is actually warehouse properties. But in actual fact, is where others are not buying is where you should be buying. And the reason for that is it swings and roundabouts. We have seen areas that has gone down in resi, we've seen areas that's come up in resi, we've seen apartments have its run, we've seen houses have its run, right? We have seen large rural places have its run, we've seen the people wanting to move regional, we've seen people coming back into the city, we've seen all of that in residential. We've seen the spike of granny flats, we've seen extensions, we've seen big mega mentions, and then downsize. So we have seen people who prefer resi commercial, we've seen the run for petrol station, we've seen the run for childcare centres, we've seen the run for the KFCs, the McDonald's, the big branded tenants, and then we've seen the sort of the strip shop malls have become popular at the moment, multi-tenancies because of that security, and of course people are paying a premium for warehouse space because they think they are secure. Now, I know there's warehouse spaces out there that are vacant for 12 months and they can't find a tenant. I know that even though the papers tell you that there is a 1% vacant rate in warehousing, it is a particular type of warehousing in a particular area that they're trying to get into. Now, if you bought something with a large warehouse tenant in there, let's say you have a large logistics that's similar to an Amazon or similar to a pet barn or something like that, and they happen to vacate, it's going to be a lot of capital cost for you to repurpose that property. Now, I always am a big believer that you should be buying something where other people are not. So right now, what not to buy is an overinflated, lower yielding property that is a warehouse property in either Queensland or regional Queensland, right? Any property that is in, let's say, in Brisbane area or Brisbane Strip, that's less than 5.7% or 5.5% definitely when we open the new year, less than that, you probably shouldn't buy it. And I know that this is going to be a bit controversial because there's going to be a push for people to sell you that, but I'm telling you, don't buy that, because if the market corrects itself, then you're going to have loss of equity. And at 5.5%, you might as well buy it back in Melbourne or back into regional New South Wales, or go to South Australia or ACT, because what you're going to find there is better returns. And well, that's in comparison, right? The other thing is going regional and paying metro prices. So what we're seeing areas like Townsville, we're seeing Rockhampton at your 7%. We're seeing things listed, the most recent warehouse sale in Townsville was at 6.3%. Well, you're leaving yourself wide open to lose your equity. So that's the type of property to avoid. Yes, it might be on a 4-year lease. Yes, the tenant seems very secure. But the thing is, you are paying essentially Brisbane fringe returns for a regional property. And if the compression happens, if the market corrects itself and the area goes back to a 7 or 7.5, you've lost equity in that deal, and it's going to take you years to actually recover. The thing with regional properties is that it can be flat for a much longer period. So it doesn't have the ups and downs that you have in metro areas. So in metro areas, you bought in at a higher price, you just have to wait until the market goes up. Then that you might want to refinance or sell, and then buy at a more correct time when the market corrects itself a little bit. You don't get that in regional. If the market corrects itself, it could be flat for about 10 years. And as a first time property investor, the risk right now of buying in regional at an incorrect yield has never been higher than before. So if someone is showing you something that is at a much, much lower yield in comparison to what it should be 2 years ago or 1 year ago or 6 months ago, then you've got to ask why. But also, if the difference between that yield and a metro yield is 1%, then come back to metro, right? So if you're buying, for example, this townhouse in Townsville was 6.3% warehouse on a 4-year lease, not brand name tenant, mum and dad tenant, a security tenant. If you were buying that property and it's $1 million and you're buying it at 6.3% yield, you could buy the same tenant, the same type of property back in Brisbane at probably 5.8, 5.75 towards 6%. You have paid too much for that property. Right? No matter what people have said, you have paid too much for that property. And I can guarantee you it's not one of our clients who bought it. Whoever bought it will be the first time mum and dad investors, because they're coming from Sydney or Melbourne and they're going, wow, we're getting 2%, because here the warehouse sale, the latest warehouse sale is 2.8%. If we're getting double that and more in an area like Townsville, that's where we should go. But they don't realize, being a local, someone would never pay for that. If you bought the same warehouse right now for 7 or 7.25 or just 7 even, at 7, it would still be good buy. You would still have protected yourself, because there's still a good 1 to 1.25% margin between you and metro area. So you've got to look at that change, right? And this is where I'm saying that other people don't want to buy office space. They don't want to buy retail. But this is the best time to capitalize on those yields, because you could get 6%, 5.5% in Melbourne. Why wouldn't you in an office space? Or in Adelaide, or in the ACT? You could get 5s in Sydney Metro. Why wouldn't you get that, even though it's an office space? Yes, there is some risk, but with risk comes reward. The same with retail, because by next year, as the borders open, no matter whether we're having the next wave or whatever it is, we are going to live with this pandemic, and we are going to find ways to get through it. And yes, the way that we work has changed significantly. We're not accessing the office the same, but there are still people who are fully back into the office. For example, Sydney's back 40% into the CBD. By mid next year, we will be back 70 to 80%. At the end of next year, we will be almost recovered to probably your 90, 95% level. In 2 years' time, people would have forgotten there was a pandemic. Just like in a very short space of time, in about 3 to 5 years, we forgot there was a global financial crisis, right? In 10 years' time, we would have probably be due for a next one, but we would have forgotten, and the office space will be back where it is. If you bought in now, you would have years to reap that reward. And look, it's positive cash flow, right? You are holding for positive cash flow. Eventually, you will get that jump. So for me, if you want my 2 cents worth, if you want to work with me, I am going to steer you in the right direction, tell you what not to buy and what to buy and what the current market is doing. And do not be led by the market. I do not believe in a sheep mentality. I believe that you've got to go counterintuitive to the market to get ahead of the market. If you don't, then you are going to lose out when the market corrects itself. And that's what I want to safeguard all of my clients and all of your viewers out there. This is why you tune into this channel. This is why you must subscribe, is because I'm going to show you, as the market happens right now, what to do and what not to do. And right now, your biggest challenge and biggest fault that you are going to make and buying wrong in this right now in this market is paying for metro returns in a regional area, right? That is the biggest mistake. And I see people do this every single day, and I don't want that to happen to you. If you want someone to help you with your commercial property journey, you want someone to walk you through the process, you want someone to handhold you, reach out to me, helentarrant.com or helen@commercialpropertycashflow.com.au. Let's get on a phone call. Let's have a chat. Let's do a strategy session so you know with clarity how you should move forward. And don't be duped by the marketing hype, by the sales talk. Rely on professionals in this industry who actually does live and breathe this every single day. So until next time, tune in. I'll be on the road next week, back into Albury, and I'll be going up to Bundaberg now that the borders have opened, and also be checking out areas in Brisbane as well as we finish up for the year. So do tune in for the other ones as I show you the different areas and how that's changed over COVID as well, so you get a real insight. But until next time, keep hunting, reach out to me, and let's build passive income together.